Ladies and gents, good morning, good afternoon, good evening. This is a new episode of Pair Trade Finder Pro, where we are analyzing the pair AJF and SCHW, which are the tickers for Raymond James Financial and Charles Schwab Corporation, two companies in the financial sector. Signal was triggered by the software March the 10th, and at those days, we had a good amount of volatility in the banking sector due to the Silicon Valley Bank collapse. But as we know, pair trading strategy develops very well on volatility contexts. As a matter of fact, correlation is the way the strategy utilized to dismiss risk substantially. So we decided to proceed with the analysis, but of course with special care and focus on understanding such a volatility context. The reward, as you see here, was $916 in only 3 days, which is huge. But let's go ahead and check the whole set of parameters in our cheat sheet, as we always do previous to take a position. First, let's check news with special attention at the context, as already mentioned. It was a very sensitive situation within the banking sector, so we want to proceed with a lot of cautious. If I go to NASDAQ website to Raymond James Financial, some analysts are reporting it is in an oversold stock from a technical point of view. Let me show you here. Yeah, that was the only thing relevant around the 10th. Nothing more apart from that, and the fact that the price was dropping, likely because volatility in the sector. Then if I go to Charles Schwab, and again I focus my attention around the March the 10th, there's two important things going on here. There was a big chunk of stocks sold by JP Morgan in what was considered an exaggerated movement by many analysts that were looking at Charles Schwab as a potential buy and recommending to take positions on it. Meanwhile, the price was dropping, but without a real fundamental reason. So volatility again caused by the context and what was going on with Silicon Valley Bank and probably the Credit Suisse situation, very sensitive too in Europe. So, by understanding the reason for the signal and appreciating that most of it is not due to fundamental reasons, we mark news with a green, but at the same time, we want to go to our trade and mark the max loss alert with a stop loss, because again, we want to be very cautious and take appropriate measurements. Earning dates for Raymond James is April 25th, so more than 1 month away, and for Charles Schwab it is April 17th. So again, a bit more than a month. So earning box is clearly a green. Dividends for Raymond James was March 31st. That's only 21 days from signal, so slightly tight. And Charles Schwab already happened February the 9th. So we marked the dividends box with a yellow due to Raymond James date and the fact that Raymond James is our short position and it can hit us if the trade is not closed in 21 days. So this is why I'm marking this one here with the yellow. Ratio chart has been pretty flat for the whole observation period. So box here is a green. Per momentum price chart, we observe that both stocks in a dropping motion. So that's going in our favor for the Raymond James short position, because we are in a downwards tendency, and that's okay for the short position, but it's against us in Charles Schwab, which is our long position. But that's the nature of pair trading, and we have to stick with the system. Maybe if you want some psychological relief for these occasions, you could place a limit order in Charles Schwab and wait until it gets fulfilled. But please do be careful to not distort the strategy, entering in a worse position than the one anticipated by the software. All in all, this is how the system works, and we have to stick to it. So this is the divergence that was triggered, and this is the signal we got on the 10th. Next one is standard deviation chart. Shows the signal in here in what we can consider, let me open it up for you. We can consider that a natural resistance level. So standard deviation is a green. RSI was 78, which is quite good, and showing a clear divergence while the ratio was growing up. RSI was going down, so that is a clear divergence, and it's quite important. So that RSI is clearly a green. Correlation and co-integration. Correlation was slightly more than 80, and co-integration was 0.85. We would like to see co-integration above 0.88, but the combination of both correlation and co-integration is quite good, because both of them are quite high. So we drive us to mark both correlation and co-integration with a green. As you know, we like to measure these two parameters together. Volatility was below 2%, and although rising, it's below our 2.5 threshold, which is kind of interesting given the situation in the sector. But in any case, we mark it with the green. CAGR and drawdown. CAGR is above drawdown, and drawdown is below 20%, which is our limit. So again, this box here is a green. So this allows us to go ahead and take the trade. Final conclusion of the analysis is we decided to bet for the pair in a sector with high volatility and allow pair trading to do its magic. I always like to describe co-integration as the way to make money, in uncorrelation as the risk minimizer in our journey. And it did work very nicely in this occasion. We got $916 in only 3 trading days, which translates into almost 23 return on margin, a figure very difficult to beat. You may argue that we took a lot of risk on this one, but as explained, there are several mechanisms that can help mitigating that risk. As we all know, trading is a risk-reward ratio, so if we deeply concentrate on what we can control, we may assume those risks to get bigger rewards. And with that, the only remaining thing on my side is to wish you very good and safe trading, and see you all in the next episode.